Welcome back after the coffee break, and as per usual we have kept the most exciting presentation to the last section of the day. So we have the great pleasure to welcome Paul Hiebert from the European Central Bank. He's the head of Systemic Risk and Financial Institutions Division and also a chair of ESRB. So this is fantastic to have Paul with his incredible experience. If you haven't had the pleasure to listen to him yet, his presentations are always fantastic. So I think he should definitely apply to be a TED Fellow and do a lot more TED-style talks on central banking. I think a lot more people would appreciate being educated about how essentially central banking works. And today, Paul will present the ECB's Financial Stability Review that was only published this morning. So this is a unique opportunity to get the freshest information from ECB. So Paul, thank you so much for making the time and being with us here in person. Welcome to the stage.
Thanks, Linda, and thanks for the opportunity to share with you some insights from our Financial Stability Review, as published this morning. Indeed, I think it seems maybe at face value a little bit peripheral to go into a general discussion about financial stability at a sustainability summit. I think you're going to hopefully be convinced by the end that understanding the prevailing challenges which are there in the financial system and also contextualizing can really help with understanding what can bring sustainability forward in this environment. And I'd argue this environment is really, really fundamentally impacted by very profound shocks. So usually we write these financial stability reviews every half year. I'm sure you're all avid readers. But at the end, what actually is true is that they're quite incremental. Not the case this time. There's quite some pronounced changes to go through. So with this in mind, I wanted to get started, which is what are those changes? And the big news, of course, which is all encompassing at the moment, is trade. But it's not just about trade. And I think we need to be mindful of the fact there are broader things going on. Now, if I have a look at this chart to the right, you see a trade policy uncertainty index. Now, this is something computed based on journalists and newspapers. And what's true is that that's way out of bounds with respect to anything we've seen since 1985, or even earlier for that matter. We don't have our data that early. What's true is it's around 60 times what it ought to be at the moment. I mean, this is an enormous shock hitting us. But what's true is that it's a whole constellation and palette of shocks which goes well beyond trade at the moment, which is impacting us. And that's if you go from economic policy uncertainty, and this is the US, monetary, fiscal, regulation, or even national security are way off the charts in terms of the scale. So we are facing much, much larger shocks than we had faced over the last, at least since 1985, in this realm. And with this in mind, it's a question one has to ask yourself in this environment is the use of the word, which I hesitate to use, unprecedented. I know people have bingo cards these days looking at unprecedented gets overused. But to be fair, I do think it's something which is quite profound. And unprecedented might actually not do justice to what we're facing, because we're really thinking about a profound regime change in the post-war regime which we had seen in operation for the better part of nearly 100 years. And that's not something that's complete. It's in play and it's unfolding as we meet here today. So with this in mind, the big question for us when we're writing a financial stability review, assessing the stability of the system, the economic and financial system in Europe, our big question is, of course, what could be the impacts of these types of shocks for the vulnerabilities we have, prevailing vulnerabilities, but also potentially new ones. So with this in mind, moving forward, one slide is just to give you the 3 vulnerabilities we've identified at the moment, which are particularly prominent. And I'm going to walk through these in the rest of the slides. But just to give you a bit of a hint at what those were going to be. So on the side of the first one is about financial markets. And we'd seen already some concerns about stretched valuations for many years now. The AI shock is not atypical of shocks, that it generates sometimes some market exuberance, which can result in some overshooting. And markets do tend to overshoot, that's well known in the literature. And what that means, of course, is that those valuations are anticipating cash flow returns, which could be a little bit unrealistic in certain settings. Now, to be fair, the other thing which has been mindful of here is concentrations. And there's a lot of concentration in the market, and I'll get to that in a minute. The last thing on the side of financial markets is a big rise in passive investing. So for the last decade or so, we've seen a much bigger role of ETFs. I'm sure many of you are familiar with these. And these are largely then generate some momentum investing, which is a little bit maybe impacting the mean reversion aspects, or how much markets rebound after shocks or continue to go off in different directions. Now, the other elements I'm going to talk about is going to be about the private sector and the challenges there. And this could be in this world of translating into risks. It could take some time for this to materialize, but this is unfolding. And last but not least is this question about the sovereign question. Do you have what type of cyclical needs in terms of fiscal space is there for sovereigns in Europe? And what type of structural pressures are there from defense, but also digitalization, of course, climate? How is that going to all fit together in terms of the climate and the other elements which are challenging the sovereign space? So with this in mind, let me start with the first. And here I'm going to briefly again get into the story of volatility. And that's been the topic du jour. I think the one thing you can notice about this chart here is it looks almost like a mirror image. And why is that? So we took the week after this 2nd of April announcement, which was coined Liberation Day. And that arguably, you saw then all across the board in terms of risk assets at the top here, it's Chinese equity through different jurisdictions, Bitcoin, gold, high yield corporates and the like, saw quite some pronounced losses. But of course, there was this 90-day pause announced just over a week later. And that led to a rebound. And such a rebound that you basically act in the markets as if nothing ever happened. So it seems a little bit of an unusual anomaly, but that led to actually some questions being posed in the market as to who might be the casualties. Where's the blood in the street when you see these types of losses, which were maybe telegraphed but unanticipated? Now, one thing to note, and I'll come back on this, is that one bit of scarring here, which seems a little bit more permanent rather than transitory, is about the US dollar. And that seems to be something which has been maybe a bit more lasting. We're still around 3% lower US dollar value than it was prior to this. Now, to be fair, what's true is it was pervasive and broad. And if you look at the volatility spike we saw here, VIX, the CBOE computes, was around 3 times its historical average, but only a short-lived shock. And I think what's very important here is you saw, A, the correlation across different assets, equities, bonds, foreign exchange, commodities. When that happens, there's very few places to go. And so if you have a portfolio, it can be hit in quite some ways which are quite sharp, lasting, and potentially quite damaging. Now, to be fair, what's important in this is not just the amplitude of the shock, but the duration. And why we haven't seen more casualties of this is probably because this duration was relatively short-lived. And the question we need to ask ourselves is what happens in a situation where the duration is potentially longer? Now, with this in mind, what we have done is had a look then at a few things which are vulnerabilities as such rather than the shocks themselves. So one of them is a bit about valuations. So we've seen as valuations had steadily trended up over the last years, both in the euro area, blue, and the United States, yellow, in the standard equity indices. It had come down quite a bit in the 2nd of April aftermath and has rebounded. And this doesn't capture the full rebound. What's true is you can compute what's called the equity risk premium. What compensation do you need to hold equities instead of something safe, like government bonds? And what we see here is that the US in particular, that's near zero. And it's well outside of its historical bounds when you go back, here in the case, to 2000. So in this historical bounds, around 50% of the observations we'd seen, this is the lowest it's ever been. It's now up here in this dot, which is effectively the blue one at the moment, I should say here, the red one at the here. And Europe is a little bit different, but nevertheless, both seem to suggest compression. So risk is still compressed, even though the shock distribution I was mentioning earlier seems to be potentially enlarged. The other element, which is much more important in Europe, is a lot of bond financing takes place here, maybe less in terms of equity. And so the corporate bond premium does matter quite a bit too, this premium over safe assets. That's come up a little bit, but it does sit at a very low level, particularly when you compare it to economic policy uncertainty. So valuations seem quite rich at the moment. And the problem with rich valuations is that they can effectively be quite sensitive to any potential bad news, tariffs or economics, and I'll come around to that. Now, one thing I talked earlier about concentration, keep in mind one thing. The US has around 4% of the world's population. It has around 25% of the world's economic output. It has around 70% of the world's equity capitalization. So MSCI indices, the ones for the globe, has a very large, disproportionate weight for the US. And if that's to unwind, noting also 30% of that US equity investment tends to be in tech firms at the moment. Because of bad news, this could be quite profound. Now, admittedly for Europe, this could have also some potential silver linings. A lot of this money is being redirected towards Europe, thinking of this as a potential alternative to having that high concentration in the US. So space to definitely watch. And in this vein, what we saw in this environment, in this short-lived stress episode, 2nd of April, is something really unusual. And that's that if you tend to go for a safe haven, that tends to be US treasuries, US government bonds. This square here gives you an idea of just how unusual we had a particular episode here, is during equity market stress episodes way back to 1990, this was not only atypical, that it didn't lie in the range of outcomes we've seen since then, but it's the wrong sign. Treasury yields actually went up, which meant that they were correlated with risk assets, which is a very unusual constellation. And to add to that, the dollar was also a little bit unusual. It was not necessarily outside of, as it was for treasuries, of the historical norms, but it was going in the direction which is opposite to what you'd expect. So this caught a lot of investors wrong-footed. And this suggests there's maybe part of that changing paradigm again is this idea that maybe the US exceptionalism story, which had prevailed prior to this, is something which may be unwinding as we see it, at least to some extent. What's true is that the big shock is what you're seeing in terms of what's dominating Bloomberg news stories now is tariffs. This red line, around 85% of news stories are about tariffs in recent weeks. So this is clearly going to be a source of potential destabilization. And to be fair, markets had stabilized, as I mentioned, with this equity volatility in the last slide, but it's far from a stable situation. It seems a little bit precarious in this sense. Now, if we move forward, the flows side, what had actually happened in this episode, and it's useful to do a forensic, even though the episode was short-lived stress, is that what we saw is that, as you would expect, risk assets sold off, so high-yield corporates in both jurisdictions. And you saw some inflows into euro area government bonds, which seemed quite good. So in a sense, this flight to safety maybe was there. We didn't see widespread liquidity stress, but that still does concern us. And why is that? If we look at investment funds, we compute something called the redemption coverage ratio, which for those of you in banking is very similar to a liquidity coverage ratio. How much can you withstand 30 days of loss before you start to dry up in terms of liquidity? In the high-yield corporate bond sector, even the investment-grade corporate bond sector, these numbers are well below 100. And that suggests that means that you're not able to withstand duration of stress, which is much longer. So whilst we didn't see much blood in the streets or casualties, we would expect that potentially that amplification mechanism, the fire sales which might ensue, as they try to raise cash exactly when it's most scarce, could maybe mean that any market correction could be have quite a large veracity. Now, that was all in markets. Let me take a shift over in the remaining minutes to talk about the other risks we see at hand. The first one is really about, I think, moving from the financial markets to real economy, is thinking about what would be impacted by these trade shocks. On the one side here, I have exports, the other side imports. The middle ring is about sectors, the outside ring is about countries. What's interesting to see about the middle ring on each is that the dependency of the euro area so the firms sector is around 84% of their exports are directed towards three industries: machinery and transport, manufactured goods, chemicals. Interesting, on imports, it's the same. Around 72% of all imports are those industries. So it's clear if you're looking under the microscope, which are the industries you'd be concerned about, those are the ones. What's also interesting in the outer circle is which countries tends to be dominant. On the side of exports, it's the US. The US is a dominant destination for euro area firms' exports. On the side of imports, it's China. China's the important firm when it comes to the import sector. So clearly with this in mind, when we're looking ahead, we'd have to be a little bit concerned about the vulnerability of US tariffs, either directly impacting these exports, or indirectly, which is a redirection of Chinese imports, which might reach Europe. So I think this is a very difficult geopolitical constellation to weather for European policymakers at the moment. And of course, adding to this, back to the dollar point, is the cushioning effect of a dollar which might be appreciating was not the case. The dollar depreciated against the euro. So the euro became less competitive in export terms and value terms. So something we're certainly monitoring. I think what's important also is to look beneath the hood and go into a sectoral decomposition. Which sectors would face the biggest challenges? Now here, this left-hand side chart, we tried to pack a lot of information, 4 dimensions into 2. And this is about reliance on foreign markets and foreign input reliance. So 2 perspectives on reliance, outward-looking and inward-looking. And you take the size of the bubble, it's about the growth of the respective sector, and the sectors are listed here. Manufacturing. That seems to be a firm which is a low-growth sector. Also, it's subject to a lot of openness, both input and market reliance. And also, the size is the share of gross value added, which is the 4th dimension. It's a large share of the economy. All of these things make us concerned a little bit about those types of sectors which have a very, very high potential vulnerability to shocks which are occurring. So what happens in this 90-day pause and how that unwinds or evolves will be very, very important for firms in this sector, to be clear. And what's true is on the right-hand side, it's not just about firms. Also on the side of households, what we've seen is there's a lot of labor hoarding. So firms are basically holding more labor than they normally would compared to historic norms, both in overall, yellow, but also in this orange line or red line, is in the industrial sector. So should there be any shocks that which impact firms, that could very quickly translate into layoffs. And layoffs then would have potentially knock-on implications. So since I'm in the world of financial stability, of course, we think about these what-ifs. It's not a base case, but it's one which maybe does concern us because the labor market has been a source of relative stability. Now, the good news is it takes time to play out. So we've done some work also in trying to compute so-called impulse responses. What happens when you have a trade shock? How does it impact the economy? What we tend to see is after 0 days, it has almost no impact, but it trickles through. It takes 6 months to 12 months, 1 year, to start seeing that these impacts start translating into banks' credit losses when it comes to firm or household exposures. And that this is actually quite important when you look at foreign input reliance or market reliance. Recall in the last slide, if you have higher market or input reliance, it tends to result in higher losses. So those losses both take time to materialize, and also they tend to be ones which are also dependent on this foreign openness, as you will. So in this world of high shocks, we're worried also about this pass-through potential to be slow, and that we're not really seeing it yet. It's not in the data, but it will come, depending on the duration of the tariff shock. Now, what's true is, if you look at the situation of banks, and I think, to be fair, of course, I'm coming with a very alarmistic picture because I'm a financial stability person. To be fair, we do have a pretty resilient banking sector at the moment in particular. So we weathered the Silicon Valley Bank shock, we weathered the Credit Suisse shock, and for now, it looks like we probably have the capacity to weather this shock, at least if it's not more severe. We have capital ratios which are well above minimum requirements. We have liquidity also, which is really quite abundant. This will help to absorb shocks, and that's precisely the purpose of these regulatory measures, is to have those in place. So the absorption capacity seems relatively strong, but of course, no reason to be complacent because the shocks could be larger than the types of 1 standard deviation shock I show you here. It could be much larger than this, depending on how this trade war or potential trade war evolves. Now, the last element I'm going to touch upon before I conclude is just this third issue we had about the sovereign challenges. And to be fair, Europe, by international comparison, actually looks pretty good. Sovereign debt ratios, either by international comparison or historical, is not necessarily that elevated compared to its peers. And this is this blue line here. So you see sovereign debt really shot up during the pandemic as a percent of GDP. It's come down quite a bit since, but it's still above its historic average here, this dotted line. Whereas on the side of non-financial corporates or households, we're seeing that they're below the historical average. So there's been somewhat of a rotation. The pandemic involved the sovereign assuming more debt and the private sector seeing some reduction in debt as an aftermath. And that process just leaves sovereigns a little bit more vulnerable potentially in a situation where there could be both cyclical pressures or structural pressures. The cyclical side, of course, is that the fiscal space to deal with a potential slowdown in economic growth, which looks very likely with tariffs of this magnitude, is going to be one which actually could constrain some sovereigns. And of course, this is for the euro area as a whole, not for the countries, the 20 countries that are part of the common currency area. And the structural pressures are, of course, numerous. I'd mentioned digitalization, climate, and also defense. Defense is, of course, a major topic now. You see here, defense expenditure as a percentage of GDP. These are NATO data from last year. And government debt due in 2 years. So what is the rollover need for government debt? countries' codes here on 2 letters, and how much defense spending that they currently have. You can imagine if you're going to push up defense spending, you'd be worried about high rollover needs or high indebted countries having to do that. For the moment, it's been a discussion mainly about Germany. And to be fair, that's been a very big positive impetus for financial markets. But to be fair, we have to think about this maybe with some caveats, that there are 3 things which might determine the degree to which we have a very positive fiscal multiplier. In other words, that the fiscal spending on defense translates into R&D, translates into also potential economic growth, will be a function of 3 things. So one is about the size and the composition of spending, which country is doing it, what size, what composition. 2 is the absorption capacity. Can you think about sectors in a perfect world which are sunsetting, say automotive sector hit by tariffs, switching and moving over some of these workers, some of this capital towards expanding sectors like defense? What process is that? How long does it take to play out? And lastly, this sourcing, is it domestic or is it imported? Is it from abroad? Those 3 things will probably help us better understand to what extent sovereign finances might be positively impacted by some of this, which could offset some of the potential pressure we'll put on rising sovereign debt as we move forward. I know it's been a quick tour. It was meant to be a fairly punchy talk. There's, of course, a very long document I'll expect you'll read in your spare time, 130 pages only. But to be fair, what I think is important to take away is maybe a few things, just at the end. I don't tend to go through this in detail. This is one of the infographics there. It's that our focus tends to be on vulnerabilities. When we're thinking about risk, it's a combination of vulnerability and a trigger, a shock of some sort. At the moment, our concern is less about the vulnerabilities, which are prevailing ones. And there is, I can come around to the resilience, is about the shocks. The shock distribution, as you saw at the beginning, uncertainty is sky high. It's delaying investment. It means household saving is extraordinarily high in Europe. These elements as precautionary motives can also slow down growth. And that's that growth feedback that is a bit concerning for us. A lifting tide, of course, rising tide lifts all boats. So the extent to which we can unlock growth potential, and this sustainability summit is all about competitiveness, is going to be key in ensuring we get a virtuous and not a vicious cycle which comes with this tariff story. And to be fair, on this, I can say again and remind the resilience is there. Our banking sector is in very good shape to start out with. So in a sense, we are rather confident that the ground could be there. Of course, the question is, will the political will and the economy be able, and the financial system, be able to pick up and also produce the growth which would be needed to unlock that potential, noting there's a lot of foreign interest at the moment in Europe in this current geopolitical environment. So with that, I thank Linda and I thank you.
Thank you so much. Thank you so much. That was
fast.
Yeah, it was fast. It was like a fast. Okay, this actually works. Yeah, no, that was absolutely fantastic. And I mean, I love a presentation with a lot of information and graphs. So I'm super happy. Thank you so much.
Thanks, Linda.
Thanks so much for that. I mean, I'm really hopeful. I love the fact that the final message was that actually our banking sector is relatively healthy. And it's actually true. What we have seen when we talk to a lot of foreign investors, especially from the US, for whatever reason, because maybe we go to New York Climate Week, etc., we get a lot of requests for a quick call to figure out whether essentially Green Deal is cancelled, etc., and where the strategic priorities are going. And actually the investors are asking because they would quite like to diversify into Europe, into green sectors. So that could be this upside from the situation. But now, since we have a train, well, I don't have a train to catch, but one of our speakers does, I would love to welcome Reiner Martin back to the stage, please. And also Pierre Monnin, who's joining us from Switzerland. He's a senior fellow at the Council on Economic Policies, and they will do a presentation together. So thank you so much, gentlemen, and over to you.
All right. Thank you very much, Linda. And let me start with a question to you. So, do you remember a moment, maybe last winter or so, you were sitting at home, it was raining outside, snowing, it was very cold, and you felt really like chilly and not very comfortable? Do you remember moments like this? Maybe in your student days or so. Okay, at least one person. I'm very happy for you that you don't remember it. I remember it from my days in the UK studying. There were many moments like this. Anyway, so what we would like to do today, show you today, is a new piece of research that we've been doing together with Pierre. I mean, to be fair, he did most of the research on how to deal from a macroprudential perspective with situations like the ones that I described to you. So it's about upgrading housing, the potential and limits of borrower-based measures in the context of climate and energy efficiency. And so we have a wonderful division of labor. I'll do some introductory words, then Pierre does the hard work, and I may give a few conclusions at the end. No? I think that's what we agreed. All right, so let me give you some introduction, or some key messages first that we'll get back to at the end. So the first one, and we have already talked about this before in some of the previous sessions, upgrading the housing stock's energy efficiency in Europe is crucial. So we had a very interesting presentation about this before. I think it's still a somewhat underestimated part of the climate agenda, but it's very important. And what we find, based on the experience of Slovakia, of Hungary, and of Latvia, is that targeted easing of borrower-based measures can help to unlock the bank's funding for such household housing upgrade projects, for retrofitting basically existing housing stock. The risk neutrality can be preserved, and this is of course very important for people like me who work in central banking and financial stability. But what we also find is to really make a difference, to really make a big impact, such borrower-based measure easing projects need to be leveraged with broader policy incentives. They can come from a fiscal, it can be fiscal measures, or it can be also monetary measures. And only then you really get a large-scale impact on the housing stock. So just some figures. I'll be super brief here because this was already mentioned this morning. If you look at the total energy consumption in the EU, around 40% of this is used for buildings. About 1/3 or over 1/3 of the greenhouse gas emissions, they come from buildings. So it's about heating, hot water, all of these things. And more or less 80% of that energy comes from that, from heating and hot water. Now that's a very large chunk, obviously. And if you want to do something about this, you need a lot of money. So there's been a European Commission estimate saying that 275 billion of additional annual investment is needed until 2030 per year to achieve climate objectives for the housing sector. Now, just to put this into perspective, because that's a huge number, this is a lot more than the average annual EU budget, right? So we're talking about very big numbers. Now you have some public funding, you have also national public funding that can be used here, but what is very clear is that most of this has to come from private sources. And most of it has to come from banks. Because the problem is that many owners of housing that needs to be retrofitted, they have limited capacity to finance these large-scale renovations or to purchase energy-efficient homes. So they need to have access to bank loans. This is crucial. And that's where the idea of the paper came from, to look at that, and the idea of the measure to ease borrower-based measures. So what are borrower-based measures? Just a quick recap. Maybe some of you are not reading macroprudential policy papers at night. I don't know. I guess you all are, but maybe just in case you're not. So borrower-based measures are basically designed to prevent excessive lending or over-indebtedness of households in this case. Can be also for firms, but here we talk about households. The most widely used is the loan-to-value ratio. Loan-to-value ratio just means if you buy a house, that then only a certain part of the value can be given to you in the form of a mortgage by the bank. Typically around 60%, something like this. Another important one is the debt service to income ratio. So you cannot get a loan that overstretches your capacity to repay it, basically. Now, there's a clear financial stability motive behind it, And two things that are important to keep in mind. One is BBMs typically work. They actually have quite an effect on lending patterns, more so than capital measures typically. At the same time, they are politically quite sensitive, because what happens with these things is that you exclude a certain part of the population from access to a loan, or you force them to buy a smaller flat or house that they would like to buy. So they're not particularly popular, obviously. Right, so what we are concerned about here is to what extent such borrower-based measures can become a stumbling block for renovations of housing. And because of this, the three central banks involved, they have launched or will launch modifications of these borrower-based measures to make sure that access to loans for retrofitting is easier, right? Without basically compromising the risk profile that you have. So the idea here is that you take into account the energy cost savings that you are making if you have a more energy efficient house, and you take that into account in the calculation of the BBM. So that alleviates pressures on properties valuation from regulatory or market expectations. And it's already backed to some extent by public support programs. And on that, I pass over to Pierre.
Thank you.
For the main part of the
So basically what I present is the result from a study that will be published together with colleagues from Hungary and Latvia. And looking exactly at three schemes that have been introduced in Slovakia, Hungary, and Latvia, relaxing borrower-based measure for upgrading household, and we try to see whether these measure makes sense. Did they change something, and whether we can improve them, basically. So here are basically the three comparisons of the three schemes that have been introduced. So you see that they are not exactly similar. Some of the countries relaxed the debt-to-income ratio. All countries actually relaxed debt service to income ratio. In Hungary, you also have a loan-to-value relaxation of BBM, and in Slovakia, also an extension of the maximum maturity. So it's not exactly the same schemes, but that also shows the dimension that you can play with when you want to adapt a borrower-based measure. And the idea again here is to relax some borrower-based measure when you want to upgrade your house, either by renovating your house or buying a new house. These are more also the rationale behind these schemes, the risk management reasoning that was behind the supervisors' thinking when doing it, and also, very importantly, what is eligible. I think the objectives was always, in two countries at least, to try to boost renovation in the countries. It was also sometimes to try to make a structural shift in the bank portfolio in general toward this kind of projects, and also sometimes to take advantage of the credits or the transition risk sensitivity that you have between such project and others. All of the central banks had, I think, a risk-neutral idea in it, so happy to relax a bit the borrower-based measure, but that should not come at the expense of financial instability. And that's basically how the measure were calibrated. How much you can increase the limits without triggering more instability, and the calibration is almost always done by the fact that when you buy a new house or when you renovate your house, then you will have less energy cost So basically, in the future, you will have a higher disposable income, and that should be taken into account in the computation of the borrower-based measure. In terms of eligibility, it's a bit different in each country. In Slovakia, for example, it's linked to public EU schemes, a scheme for that, and otherwise sometimes it's to buy a house, sometimes it's also just to renovate. And the problem we had when we wanted to see does this measure work is that Slovakia has introduced it since 2 years, Latvia 1 year, and Hungary just introduced it, so we have very limited data. The data that we have from Slovakia shows that there is an uptake of such loans, but not a huge uptake. And what we did was to ask banks to survey and ask them questions about how they sell this product, how the product is perceived, and what do they change for them to get a sense about their success and how they can be improved. You will have a few more results in the paper. I'll just show you important one, I think. So in all countries, you don't have a high demand for these loans. So all banks say it's either moderate or a low demand currently for green loans, so retrofitting loans, housing upgrade loans. And they also don't see a very fast growth of such loan in the future. So mostly they see, so it's either a growth that is in line with other loans or a bit lower. So in that sense, there is no fast growth of these loans expected, which could be also good in terms of financial stability. When we ask them about what would drive the demands for such loan in the future, and that's mirror also the question what were the bottlenecks for the demands. Mostly it's the public policies and subsidies that will be in place. Also, one of the bottlenecks on the opposite is to say that there is no clarity about policy or about future policies. So I think future policies and subsidies are a very important driver for growth. What is also important is for households to see if there is actually financial benefit to retrofit loans with what you save on energy bill. And another thing that is relevant for the demand is whether these loans are cheaper than others, if you get some financial incentive out of them. So there is also some consideration about bank competition for that. But that's the three main drivers. We also ask them if, since the measure were introduced, they see a change in the risk profile of their portfolio, which is important for financial stability, or if they expect to see a major change in the future. And there, most of the banks say there is no impact on risk on their portfolio. They don't think there will be an impact. Some of them say a moderately increase or moderately decrease, but I think in general, that's in line with what supervisors expect, not to have like a huge increase in risk in the banking portfolio. The few policy insights that we get also from the answers, and also as how to improve the measure. So one thing that I think is very important is that basically these kind of measures target a very narrow circle of potential borrowers. It's the ones that are constrained now, that are owners, that want to buy a house or build a house. So it's a very narrow very narrow segment, and so it's good for financial stability in the sense that you cannot expect major change in the portfolio of banks, but it's not good for renovation purpose in the sense that it's not conducive to a large scale housing upgrades everywhere. We also see that there is minimum financial incentive for household and banks to do that. You can borrow more, but you don't get subsidies or you don't get lower discounts, so there is no financial impulse to do that. So our conclusion is also is that fiscal measures that and public financial guarantees or monetary measures such as targeted refinancing operation like in Hungary can provide this kind of financial incentive that are complementing the easing of the borrower-based measure. And on notes, banks also responded that it's quite administratively cumbersome to do that, and there is not a wide marketing. People are not really aware of these schemes, so you could also improve the process there and maybe market it also publicly to a wider public. I think I give you that for the conclusion.
Okay, well, thanks very much. Yeah, I mean, this brings us back to the beginning, I think. So what the comparison of the three measures shows is that borrower-based measures can be eased on a risk-neutral basis. And I think this in itself is an important fact, because what we do not really want is that borrower-based measures become a stumbling block or a roadblock for renovation and for improving energy efficiency in housing. And that can be achieved. I think this is clear. Of course, as Pierre said, the impact is relatively small. And I think if you want to change this, there's a couple of things that would need to be done. One is really fiscal measures to make it more financially attractive. This is one aspect. Another aspect, I think, is also how it's advertised, how it's publicized that these things exist. And it's quite interesting. In Slovakia, it was actually our banks that came to us and said, we see a potential problem, can you do something about it? And then we did something about it. But then afterwards, they didn't go out and sort of went into a big advertisement spree about this. So maybe this is something where more could be done. And I think the last point is also to say that, of course, you have these measures in only a relatively small part of affect only a relatively small part of the population. And as was mentioned this morning, and I think that was really interesting, there seems to be a lack of understanding by the general public that actually if you renovate your houses, this can generate tangible benefits in terms of reduced energy and heating costs. And here is also a public policy course, I think, that should be set. Not by us, I don't think this is for central banks or regulators, but I think the government can certainly do a lot more about this. So on that, thank you very much.
Thank you. Okay, there we go. Thank you. Thank you, Reiner. Safe travels back to Vienna or Bratislava. I'm not sure which city you're headed to. Probably one of the two. Vienna. Well, enjoy Vienna. And thank you, Pierre. We might involve you and also Paul into the next conversation in some ways. But with that, we proceed to the final session, which I think is very interesting. So James Vaccaro, please, would you join me on the stage? If you'd like a headset, you can get it over at the back, or you can have a Madonna mic. It's up to you. So just a quick background on James. I think I first met James many years ago when he was still at Triodos. It was in Brussels. And it was a very interesting session talking about EIB becoming a climate bank, etc. And we had a really good discussion. It was actually a highlight of that trip because it was a very depressing trip for various reasons. So thank you, James, for joining us today. Then we also have Magdalena Andrejčuk. She is the Director of Sustainable Finance Department for Corporate Banking at mBank in Warsaw. We had the pleasure to work with Magda on creating an event for the EU Sustainable Finance Platform, then doing a CE report for the platform, and then we even had an event in Warsaw. So it's been a long, ongoing collaboration. We also have Ugo Bigeri. He's the representative of GABV and a co-founder of Banca Etica. So if Ugo would join us on the stage as well. I can't see Ugo, but we'll find him. He was in the room a little bit earlier. And we also have Goran Djeras, CEO, co-founder of ECOS and cooperative manager of Zadruga za etično financije. I don't speak Croatian, obviously.
Cooperative for ethical financing in Croatian.
Exactly. I do like the local languages, but I think the third day of the summit is taking its toll. But we spoke to Goran several times discussing his work on ethical banking and actually creating a new bank that would act ethically and essentially be an ESG bank. But over to you, Magda and gentlemen. Enjoy the discussion.
Okay, perfect. Welcome to the final session. This is where things really start to heat up. I'm going to come in. I'm going to come in here.
Sorry, I forgot one speaker in the rush to start. Of course, it's the very first one up there, Gergely, Peter Calais. He's joining from MBH Bank, which was actually a partner last year, and he's recently also been promoted, I believe, to a new role. But Gergely, please join on the stage.
Thank you. So this is looking out far-sighted. We've just heard quite a lot of the near-term shocks in the system. It's about the most volatile that most people can remember. And it said this morning, it's like, well, bankers are always opportunistic. But like the waves and the tides, the waves are kind of coming in and out, and we can all be dizzied by that. But what is it that's really going to drive the future of banking? What would be if we really cast out to that horizon? And that's where some of the things which have in these past few days that we've covered in terms of the inevitability of some of the things in energy transition really come up, and potentially some of the inevitability of the real impacts of climate and other sustainability kind of crises really hitting our shores. That is going to transform the landscape that banks have operated in. We are now moving into another era. When I look at the horizon, I can see a lot of people are right at the back, and it would be wonderful because of my poor vision, eyesight. Come forward. We're going to take a step forward in transition, like you can actually move forward, because we can kind of bring this in to a conversation. We have 35 minutes. It's kind of coming up to the end. This is going to be incredibly brief in terms of conciseness. So I'm going to invite all the panelists to also be very concise. I will be concise with questions. If you need to borrow time, very high interest rates on the borrowing for that time. That's the rules for this session. And I'm going to invite, because there's many in the panel, jump into every question. We won't hear from every one of you on all the questions, but I guess to start off, we've heard a lot about the financial sector and what it's for and what's the remit of it. We had the remit and the mandates of central banks. What about the remit for banks? Because for sure, banks are there to manage risk. The question is, in the future, are they all now for managing impacts and the contribution to these systemic risks? Some already are, but I'd be really interested in your views in terms of, will that be the direction that they go in? Because there's some diversity there. So is impact part of what the banks of the future will be managing? Who'd like to start on that?
I can start, if I may.
Please.
Yeah. Hello, everyone. Thank you for invitation to the panel. This is a great conference. I'm the first time here. So we discuss about the future of banking. I think that I'm representing the banking that is already in the future, because the bank is very digital and online focus, and that's mean that we also engage in the sustainability and in our strategy things. I don't know that I need to introduce the bank, but I really want to underline that this is the bank that also operating here in Czech Republic and Slovakia, so that you can also have this opportunity to know something about that institution. And coming back to your question, I think that this impact of the bank will be, and already is relating to sustainable finance and the products that we already set here in Europe and here and all over the world. That's mean that in the banking strategy we have set the targets for the sustainable finance. This is kind of our business issue, how we deal with the clients, how we cooperate with them. And this is very important things that we're seeing that there is most the popular things like the sustainability linked loans or the green bonds, even in the small market as the Poland market. And I can tell that there is like some kind of comparison that we see that over 50 billion zloty. That's about. I can try to recalculate to euros, but this is the amount of sustainability linked loans value, and it's also something that we can underline like a part of the engagement of the company and the banking sector with the sustainability. So from my perspective, this is some kind of the business issue and the business strategy, especially when the undertakings, the real economic sectors is involved in that strategy as well.
Thank you, Magda. Others, maybe Ugo, because you carry across from all of Europe. What do you see as the trend here? And maybe you can say a little bit about the context.
Well, I am working in the Global Alliance for Banking on Values. There are 21 European banks, European in broad sense, so up to Georgia and Armenia. And there are 75 in the banks all together in the world. These are all banks that are very committed to evaluate every single loan with a social and or environmental impact. About your question, I should say something which maybe is not so, is a little bit disruptive, but I think generally the banking system is a very comfortable situation. The banks are creating commercial money, so they really don't risk so much. I mean, who is risking is the entrepreneur sector, because banks, well, we know that banks don't bail out. The bigger they are, the most are saved by the governments. And so I don't see that voluntarily the banking system, the traditional banking system will go in the direction of sustainability. I'm sorry to say that, but I think it's quite evident. You see now when Trump is coming with his new policy, everybody is going backwards, no? So I think from one side we need not to have a lot of regulation on sustainability, but to have regulation or disadvantage in unsustainable finance, because the other way around is not working. And secondly, I want to say some positive. I think retail customers are very interested. And I know, well, you can say, oh, maybe half of the European population is not interested in sustainability or thinks that the Green Deal is a bad thing, but the other half not. And this means that if you have customers that believes that you are not just doing some sustainable product, but you try to act as a World Bank in a sustainable way, then you have very stable customers. And the experience of the Global Alliance for Banking on Values, we are relatively little banks, is that all these banks are very profitable, have a stable profit, doesn't matter if there are crises. They are increasing the portfolio loan, they are increasing their capital, because people buy shares even sometimes without having dividend, because they believe in those kind of banks. So from a marketing point of view, there is a huge room to do seriously sustainable finance. And I think the driving force will be more from the customers, the responsible customers, than maybe actually from the regulator.
Okay, so maybe this potential leaders, but also not everybody going in the same direction, and more from regulation. Let's zoom in maybe, Goran Gergely, in terms of this region, in terms of the banking sector and the response to some of the sustainability trends. We heard yesterday there was a discussion with the Automakers Association and talking about European regulation, but what we see from the meta trends is that there's actually going to be displacement really very soon in this country, from what I understand from Chinese manufacturers, electric vehicles. So there's one thing which is policy and regulation, and there's another thing which is just the inevitable direction of transition. How does that affect banking sector here, and what maybe some of the leaders and the new thinking have to offer in this region?
So I think that for a Hungarian bank or for a bank in general, it's a pivotal role to shape and support this economic transition. And the MBH Bank is a local Hungarian bank, and we have initiatives and we are supporting our customers. And what is good in Hungary, maybe that's not the case in every other countries in the region, that the Hungarian National Bank and also the government have initiatives in Hungary supporting sustainable house renovation and solar panels and things like that. So that is very good, because the customers are not very willing to take such loans, because those investments are pricey. But because of the government is incentivizing with subsidies, and also the Hungarian National Bank with providing very low interest rate funds for bank, it's much easier and it's much profitable than usual.
Maybe just a quick sentence about the particularity of Croatian banking sector. So regarding sustainability, Croatian banking sector is dominated by four not Croatian banks who actually chose mostly, in most cases, to delegate sustainability policies to their home offices. So usually they are just following what is coming from Italy, Austria and Hungary, where the four largest Croatian banks, comprising for over 90% of the banking sector, are actually coming from. But I would come back a little bit to this systemic thing. So if we are looking to the future of banking, I'm now 19 years in banking business in various roles, starting as a consultant and now in more in a role of practitioner or a future practitioner. I am more and more terrified about the tremendous amount of work that is ahead of us if we really want to authentically address sustainability. So just listen to the conference here. We are talking about, I don't know, green loans comprising 10% of the portfolio, 5%, 30%, etc. But if you just go back to the term of sustainability, sustainability is not something that we can negotiate with. So if we are 30% sustainable, it means that we are 70% unsustainable. If we are 90% sustainable, we are still unsustainable. So it is something that actually, if we want to be sustainable, we need to be so transformative that we actually can come to the point where we are 100% sustainable. And being unsustainable means to disappear, to die, actually. And if you are just less unsustainable, it means that it will take longer, but the outcome will be the same. And that's actually something which is really, really troublesome. And if we want to come to the root of the problem, we are mentioning here regulation, and of course the regulators are doing a tremendous job in trying to change policies within their framework that they operate. Banks are doing a lot with what they can do within the framework where they operate, but the problem is the framework, actually. The framework is the one which is designed from the very basics, from the very accountancy principles, that it demands unlimited, unsustainable growth. So if you are just stable, you are not good from the very beginning in our accountancy, etc. And it cannot be resolved without some real combination of political, regulatory, population actually initiative that will change very, very basics of what we do and how we behave with the banking. I think that if we are just trying to solve problem by round pegs put to the square pegs put to the round hole. It is just not going to work, and that is what terrifies me.
So let's maybe get into some of the messy middle, because it seems that most banks would be interested in the green transition. Why wouldn't they? But there's a lot of stuff which kind of is in this kind of very grey zone. The stuff which is unsustainable, the stuff which is maybe from a broader perspective, harder to see the immediate win-win. You look, for example, there's great progress on the pricing of solar, but then what about human rights considerations in supply chain? You look at some of the transitions and the social impacts of transitions. Magda, we were speaking earlier about some of the stuff in terms of fossil fuel transitions in Poland and the leading role that you've been playing there. What about the sustainability issues beyond those more obvious win-wins, the kind of the gritty stuff which, as you, Ugo, said, is probably going to need to be managed in some way by regulation? What are the kind of the initiatives? What is it that banks can do, and what is it that is the next step for whether it's regulators or governments? Because everybody's sort of looking at one another, looking to move, but it doesn't seem like there's actual tangible progress yet, or maybe there is.
Yeah.
Magda.
So from my perspective, I want to I want to disagree with you about this sustainability, because part of the portfolio can be in transition, and I have the example on transition in practice. So imagine we have electricity power plant, Pątów, Adamów, Konin. Doesn't matter, but this is the fifth electricity producer in Poland, and the second volume Polish producer of electricity generated from brown coal. And this is companies who is publicly listed on Warsaw Stock Exchange, very oriented to transition into the lower emission sources. And the starting point was 95% of the from 2020 to 30% of coal in 2025. So that means that they are decommissioning of the coal production, and somehow the development of electricity generated from renewable sources and so on. So that's part of the transition that we are looking, and we want to support as a bank. But the starting point that this was the company basis on the coal, yes. So that's not mean that we are starting always with the very pure companies. And can you imagine that we have like 140 billion zloty, that's around 33 billion euros amount of money, and I can have the quick quiz with you. This is the value of IT sector in Poland, or this is total spend for the fossil fuels in Poland for 2023. And the answer is the both of that. So this is the equality value of how much Polish government and Polish economy spend for the fossil fuels, and we need that transition. We need to, we see that the starting point is very hard to transition to low emission economy, but for us is like, for these 2 days we discuss about the security, the low cost of low prices of energy, and also that brings us to also low emissions. So from my perspective, it's not about the regulation, it's also about this very economic point of view, and what is the most we can say costable, and we also using that word as banking, like this like this all the innovation and investing in the part where we see the profit on the end, and the profit is where we have this transition from the high emission to the low emission. So, but transition also should be the just transition, and this is the part, the speaking what we discuss about. So we also need to think about the social issue about the employees and so on, and this is very important as well in this topic.
Maybe I can be a bit on the positive tone now in the second round. I think actually that still, however problem large is, there is a lot that could be done by practitioners. Some of the examples we have heard here as well, but nothing prevents banks to go beyond the regulatory standards. The ethical banks are doing it, as Hugo has explained in the GABV, and try to find models how they can integrate those sustainability indicators into their value at risk measurement. Actually, that's a key thing. If you manage to expand your horizon, and if you see that actually those risks that are maybe not visible in the standard risk assessment methodology, which also is relatively short in the horizon, but you expand that horizon and you are aware as a bank of the risks that are coming further on, systemic risks, maybe your policies would be different. That can transfer to the shareholders, to the ambitions of the shareholders, because ultimately the bank on behalf of shareholders defines its risk appetite, so what they are going to finance. And there is evidence that community banks, public banks, cooperative banks that actually are owned by customers and by the community in some way have different risk appetites, because their priority is not maximization of profit, but actually maximization of value that they transfer to the community in which they operate. So basically there is a range of examples what can be done, and we see that those models are now gradually being transferred to businesses as well. For example, in the Netherlands, just a month ago, the Dutch Parliament decided to introduce a new legal form of the company. It's a stewardship-owned company, which actually doesn't have individual owner. The owner of the company is a foundation, which has its societal or environmental mission, and actually all the profits of the company are not paid out as dividends, but invested in fulfillment of that mission. And we see that that's what people want. Hugo also mentioned that clients like what ethical banks are doing. And if you just look generally, more broadly, I was last week on the workshop where there were many funds that were related to faith-based organizations, and the people that were there represented 1.7 trillion of assets that said that they just don't have currently enough financial infrastructure to put the funds in a way that is consistent with their values. And that's something that we all can work on to actually find and link, utilize those funds and go beyond the regulatory standards, but develop the culture of banks and organizations to develop a different economy.
Yeah, let's just... Yes.
One more thought. For me, what is very important is education. So we as a banking sector, we have to educate our stakeholders, employees, customers, shareholders, everybody, to make it clear for them why it is important, because usually they just see that these investments are costly, and they cannot clearly see how long is the payback period, or this project will be profitable or not. And if we educate our stakeholders, then I'm sure that we can generate demand and we can make the future more sustainable.
So this is interesting because it came up earlier, and the presentation from OTP Bank was saying, actually, education of corporates doesn't maybe always work. I can imagine that in some of the areas where there's things which are unfamiliar, in things like real estate, it can those insights are new. There's some win-wins. But I wonder, Magda, it's worth just repeating those statistics. That private energy company, which was based on coal for, you say 95%? Only and then now 30.
30, yes.
30.
And we see that in the CapEx, they have a 40% align CapEx with the EU taxonomy. That means that they invested a lot in this renewable energy.
So not necessarily to focus in on that one, but my impression is that isn't the normal path at the moment for a lot of companies. In fact, the big headlines for a lot of the large conventional energy companies has been rolling back on, especially oil majors, for example, on targets. So maybe they don't see, from an education point of view, the instant kind of cash generation opportunity as something that they can miss out on, even if they do understand the long-term scenarios. So I wonder, again, just wanting to get into the messy middle of, so what then is the role of banks? Because bits of incentives and pricing can go so far, bits of insights, but what is it that needs to be done? And if it was regulatory intervention, what does that even look like?
First of all, I think every drop counts. But so very good if there are banks committed in the transition. If we are looking to the future of banking and with the lens of sustainability, for sure we have to change something dramatically. And so, for instance, we have to have strategic goals else than profit. And net zero was a strategic goal that to be achieved, and now is not so important in the mainstream, in the general banking system. So we have to think to do something in that direction. And this means that you cannot, it's my opinion, in the future, just think about sustainable finance product. You have to think as a whole system of finance who act differently. And for instance, it has to do with the transition problem. You have to learn how to manage ethical dilemma, because you will have this continuously. Of course, the Global Alliance for the Bank on Values, which are in the Global Alliance, they are in a niche. They decide what to finance. So it's, let's say, relatively easy. Yeah, but when you are a normal bank who has to finance everything, then you face ethical dilemma, and you have to learn how to manage, how to measure, how to give incentives to your co-workers in order to achieve strategic goals else than profit. I mean, there is a professionality behind this if we want to achieve sustainability in banking. And my little part of pessimism, I think on these things there is a lot of things to do, and there are a lot of people who are studying these kind of things. My little pessimism that I start with before is that, let me make a very clear, maybe too dramatic comparison. Until 1830, there was slavery in the world. At some point, it disappeared, or well, not totally, but mostly, yeah? It disappeared because there was a cultural shift, there was an economic shift, there was the population in the world that don't want any more slavery. There was also the corporate social responsibility of the slavery industry, but it was not because of the voluntary decision of the industry that we stop slavery. And I think we are in a very similar situation now with facing the sustainability challenge. Voluntary act is very important because it creates the cultural change who will hopefully brings to a different approach in regulation, because we cannot regulate the one who do things in a sustainable way and unregulate the unsustainable behavior. We have to do exactly the opposite. So not today, not tomorrow, but if we look at the future of banking, this is also the bank have to ask for that. Because otherwise, if the rule doesn't change, it's profit, it's business. You go where the money, when you make money, no way, if it is not forbidden, you will do it.
Yeah, and that point on the green taxonomy and regulation, I mean, this room, this space, this sector has been full of people working incredibly hard on the details, and yet the unsustainable side hasn't seemed to have borne the burden despite it having a disproportionate...
Any barrier.
Yeah.
Bureaucratic barrier.
And when you ask about this role of the bank, I see the bank as a leader, and that means that, for example, like our bank is stopped financial, the call in 2020, in 2019, and we move our capital to the renewable energies, and that means that now we have the portfolio of renewable energy, one of the biggest one. We are the fifth bank in the Polish market by the assets, but we are one of the leader in this financing the renewable energies, because we see there like opportunity for us and for the sector to transform the economy. And this is the crucial role that we are on the market. And I think that this is the role of the bank, to be one who changed the mind, to convince the clients, to convince the society to change something and transform to the lower emission sectors, because this is the future. Transformation is the future, and we already in the CE region, we know already what is this transformation, yes, the economic transformation. So for us, the energy transformation is something that there will be the new experience for that.
I like that, and especially there's education for clients, but also for other stakeholders, including also policymakers. I mean, we've heard a lot about like, well, we need the policy environment because we can only do so much. But then if I was a policymaker, I'd be saying, yeah, what then? Goran, I just wanted to quickly come to you because you've been setting up a bank. There's not the legacy, there's sort of the freshness of perspective. What are the things that you've most learned, and if you were advising new banks setting up or banks kind of making a big transition in their strategy, integrating strategy, what key advice would you give from your insights?
I think that's the most important thing is, of course, to be realistic and to understand what a bank can do as a bank and what actually needs some more systemic change to do that. But the culture, again, is actually, I think, the most important thing, because, and it is so deeply embedded. If we just think about terminology, we are now talking about ethical banks. What does this mean? This means that the definition of the word bank without this prefix ethical means that the banks are unethical. But we have it everywhere. We are talking about, I don't know, tax burden. So it means that paying tax is bad because it is some kind of the burden, it is negative. But if we find a way how to avoid it, then we go to tax haven, which is, like kind of the good thing. We need to go to special shops to buy healthy food because the ordinary food. So this is what I mean under the culture. So if we develop the culture of a bank as any other institution in a way that actually it reflects what are the needs of us as society, as community, as planet, then we would have good foundations to actually deal with everything else, with the regulation, with our decisions, with ethical dilemmas, with other things around. And this is a long-term process, so it's something that we just need to start immediately because there is just no alternative to it.
Thank you. I'm going to prime for questions, so start putting hands up and thinking about questions, because I'm going to take one round if we can. But before that, I wanted to, because you have to say AI, because just that's the rules now. I think that's the chip in my brain speaking. We all think about the future and it's AI. But actually, in terms of banking and sustainability, it's just like, well, there are positive use cases potentially, but there's also, some of the side effects of, well, if everything becomes beautifully automated, then aren't we just going to use these amazing, language models to just extrapolate what we've been doing in the past really efficiently? And isn't the transition all about doing new things which we have to explore and try on and do the things which really get us back into that new culture of banking? And Gergely, you'd looked up, I think, something about asking AI itself what it thought of the future of banking, and I wondered if you might share a reflection before we take questions.
Yes. When I was preparing for this session, I asked ChatGPT what it thinks about future banking, and let me read the answer. The future of banking will be shaped by how efficiently the sector embedded sustainability into its core operation, transitioning from a compliance mindset to one of long-term value creation. Banks will play a pivotal role in financing the green transition, managing climate and social risk, and fostering inclusive economic growth. Success will no longer be measured solely by financial returns, but by the sector's ability to drive positive environmental and social impact.
There you go, ChatGPT, the most optimistic stakeholder on the panel. Who would have thought that? Let's take a quick question over there. And any others signal before we're going to have to wrap up soon? Yes.
I think I'm a bit in shock after that. Just a question sort of tapping into what Goran said and Magdalena has said earlier. And it's about, we've seen some brilliant presentations at this conference about looking at the data of technology transition around energy. And I'm wondering how much time you as bankers spend looking at your loan books or even banks, looking at your loan books and thinking about the value at risk of that technology shift, particularly given the context of the Czech Republic and the car industry, which obviously has huge outstanding loans from banks, and you would think that there would be significant value at risk if you think that data is correct or you are unable to challenge that data in the right way. And then at the same time, what does that mean for loans that you are making now and what you think they are going to be worth in the future?
I can say that too long, yes, we see the data. So it's too long to watch that and analyze that stuff. But also there is sustainable is the relating to reliable. So for me, that's mean that if we are looking at this investment and trying to assessment on the investment from the risk opportunities and from the risk and the opportunities, we also see how it's affect the market. We have the data from the others company, others sectors, and we can compare that. That's so. Answering your question, this is very important to see this whole landscape, not only one portion, one company. In that matters.
Yeah, but definitely data is very important, and to collect, there are more and more data available, and AI can also help in this regard to collect data, because right now one of the biggest problems is still that how data are available and reliable, and yeah, that's a big problem. But when we will have more and more data, or KPIs estimations will be more and more accurate.
I think there's one question, and then I think we'll have to close it.
Okay. Do you want to
Oh, sorry, you had the microphone. I'm so sorry. Yes.
Okay, I will be brief. Goran, you mentioned the examples of 10% of the portfolio being sustainable, or other examples that are obviously not enough and it's not fully sustainable. What's problematic is that from the top-down perspective, people see it as enough from these positions, and that's what's so problematic. They don't want to go further. And with the upcoming omnibus, I see this as a really big challenge. And if the customers don't make enough of a push, then what else is out there to push it forward?
Yeah, I don't think there is alternative than public awareness and public pressure, at least in the current political situation, where the focus shifted from sustainability, which actually had its time just a couple of years, to security, defense, trade wars, etc. But still, if we look the priorities, those are political priorities. Recently, I was talking to my friends, and actually basically, when we were just discussing, nobody of them wanted to have their personal money being used for defense purposes. They just don't think it is the priority for us, for communities, for humanity in general to do this. But they are forced actually to participate in funding defense, except if they are members of the ethical banks that have explicit exclusion on that. And how is this going? It's going that the Commission decides to create the instrument that would be able to engage private capital, then the banks would be, then the governments or I don't know, government organizations would be issuing bonds that are going to be defense, and those bonds would end up in some saving mixes that are available by your banks, and people without even knowing would be actually funding defense. And this kind of the education that explains how it works and that would allow people to have choice what they can do with their money is actually a very large potential for mobilization that ethical banks that exist now are already tapping into, but we need to build up and to create actually this awareness much larger than it is right now.
I think we will need to leave it there, unfortunately. The thing with banking is that its entire premise is taking the short-term money and lending it into the long-term. It's all about the future. And this, oh, we've got sorry, it's because it's the light.
Yeah, sorry. Just stand up. My name is Gergő Vider from KPMG, and with the banking industry, I think one is the biggest problem is the big inertia. So the loan book is very big. Even if we change our policies and strategies and so on, it will take 10, 20 years to clean the loan book. So if we disburse a loan now, maybe it will be 2050 when the whole loan was paid back, will pay back. I see that the low-hanging fruits like renewable energies or energy efficiency is very easy to finance because it's good for economic point of view as well. But I see the biggest problems if we're talking about future, what will happen after 2030, 2035. Because, for example, previously, the whole automotive industry was thinking about what will happen after we have to change to EV cars and so on. But this agenda seems it will be postponed. But it is a very hard topic for the banks. What will you finance? How do you know what will happen in 2035, 2050, 2040? What is how you prepare this internally? How you think about this?
Yeah, so there's the runoff of the loan book or the stranding of loan books. And in a way, the banker's role is to look to that future. That's kind of what they get paid for. But let's take a few perspectives on that in terms of the existing legacy books that we have.
Of course, but we have to change. And the later we change, the longer the books will remain the same. The bank are anticipating the future. We are doing this. We are with loan. We are anticipating the future, and if we don't stop anticipating an unsustainable future, there will be a problem. So at some point we have to start seriously this work, and I think every one of us is committed to that. But maybe the pressure should be a little bit higher, and the professionality we put there should be more systemic and not just on a single sector.
Any others?
I think that when we build up our balance sheet with green assets, with that we can use those assets to issue green bonds, and with those green bonds we can finance even more sustainable initiatives. And at MBH Bank, that's what we are doing now. It's trying to generate as much as possible green investment to make it possible for the bank to issue green bonds.
Yeah, so long-term perspective, strategy, thinking, business case, this is the answer for the question. So not thinking about now, thinking about the future in the long perspective, like prepare transition plan for the much longer than perspective for 2030, for example.
Yeah. And I suppose it is something that time will tell. There is maybe a dilemma from some of the banks with the legacy polluting and most at-risk portfolios where are they going to just try and extend that out? Or is it going to mean that central banks will have a different kind of conversation about the largest bad bank, which will have to be created for all those stranded debts? We will see. I just want to thank the panel. I want to thank the organisers for this whole week in terms of being able to keep the focus on the future and really be able to harness all of the creativity and the dedication of the sector. Thank you all.
Thank you.
Thank you so much. I think this was an excellent way to end. I do like the fact that we're getting more and more ChatGPT presence, so it's kind of like the 6th or 7th panelist often. It's also very interesting to sometimes hear some speeches nowadays. I don't know how many of you have noticed the same sentence structures, and especially social media posts. We were discussing that with someone today, talking about communication, that an occasional mistake in terms of grammar or something else happens, and it actually makes us all human. So on that note, we have reached the end of the summit. So I would like to welcome my colleague Julian back to the stage very quickly. We do like the kind of full circle, right? We started with Julian and we end with Julian. Faster. I think everybody wants to go outside. Where's your mic?
Oh, yeah, mic.
You see, this is what makes it human. Yeah,
I had no idea what was the next slide, by the way, but I'm here.
Okay, good. So, first of all, we would really like to thank our team, right? So, you all know how it goes. Without the right people, without the right mixture, nothing happens. And a special shout out to Katarzyna for the design. Lukasz is actually the person we coordinate all the photography with. He's with us for the 2nd or 3rd year. He has a fantastic team, and it's been a real pleasure to work with him. And also Creative Pro, we are so happy to be working with them again. We started with them, and we will continue with them. It's just such a pleasure when everything works and the communications are easy. And communications, trust me, are one of the key things that matter. One more thing is, well, we love it so much, we're doing it again. But this time we are moving it to September because, as you saw on day 1, we had a lot more academic presence. But academics are busy people, and May is probably the worst month to host a summit. So for that and for various other reasons, we are going to have it next September. So I really hope that you will get in touch and get involved. And even if you have ideas, etc., you will tell us about them. That you will also follow us and post about the summit and spread the word. Every year it's a real battle to mobilize people because there's so much competition on different events. And well, guess what? We do think ours is better, or at least good enough to not be embarrassed about inviting people.
Okay.
Yeah, and then.
Nothing much to add, but it is usually, and I said it yesterday, I think, it takes a while to prepare it. It's pretty intense sometimes. We do have an amazing team, which Linda said many times, and I think I'm actually really glad because many of you, if not all, actually got to know the team as well. And it sometimes gets really intense during the event as well because it is a pretty complex agenda. It's a lot of different topics. We have roundtables and so on, and it's pretty packed. But while it sometimes gets, like actually we feel it then on the last day, it's always looking back every single year. Like usually like last year, last day for me personally is like, oh, Jesus, never doing this again. And then we actually look forward to that already 5 months coming to the next year. So I'm glad we have more time to do it even better. And I do like that now after 5 years, and this is something we probably see very often, we did create sort of like a community of people coming to this event, but I'm really glad to say also there's so many new companies, corporates, financial institutions, even ministries. It's so many more people we see every single year, but obviously also getting the positive feedback and people who already been here coming back and new people.
Yeah, the return factor I think is very important. If people don't come back, that's it. Kaput.
It's hugely important, especially because, and this is something we have discussed with many of you and also in roundtables, and I think you agree, and I often say that in conferences, we are in a bubble often, like we hear what's happening here, right, what bankers are talking about, and usually it's people working on sustainability in banks and so on. But that bubble is definitely getting bigger. I think it's actually going from just, some kind of theoretical discussions to practical things, very much, especially in terms of transition and opportunities and how can we link it to strategy. So now with Omnibus or with all the backlashes and so on, I know it's not a straight line, it's ups and downs, but I think still going in the right direction, and it's really nice to see this bubble growing as well.
Yeah, and I think on that note we will finish. One last thing, of course, we want to also thank Julian, who has to tolerate midnight texts and grumpiness in the morning when I haven't had coffee and I'm absolutely raging about a typo on a post. So thank you for that.
Oh, wow.
Anyway, we also would like to thank one more person who you probably saw floating around and doing loads of things. And Nicole, back to the stage, please.
Yay.
In the interests of time, we had to split the kind of gift giving and thanks into 2 sessions because we're not going to keep you for longer than 1 more minute because we know that we all want those drinks outside. So thank you, Nicole. Nicole rejoined us while she was on a farm in Portugal doing some pretty cool stuff. And we were like, you know what, just come and create Climate Week, you know, we just got rid of someone else and nothing can go wrong. She jumped straight in, and it's been a great success. It's fantastic to be working with you again. Thank you very much. And yeah, we will thank the rest of our team. Can you raise your hands, everybody who's with ISFC? There they are. You can go and chat with them and find out what we're doing. But yeah, thanks again. The rest of you, I know, don't like the limelight, and you're going to be very angry if I ask you to come up here, but we will celebrate in our own way as we do every year after this is done and we have had some sleep. So thank you again for joining. Have fun and see you hopefully next year.